From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 14th, 2022. Checking the calendar, the Milwaukee Bucks open the season on the road this Thursday in Philadelphia. Your Green Bay Packers are home in Lambeau with the Jets this Sunday. The Waukesha Farmers Market is open this Saturday, and there's a mess of haunted houses you can check out. And for something completely different, how about Sunday yoga at Forest Home Cemetery? Well, it is Halloween in a couple of weeks, so it works. Let's start with a public service announcement. Trader Joe's is offering free samples again, and once again, you can eat for free while you're pretending to shop. We have a brand new recession indicator. You can forget about GDP, income, and unemployment. Owners of luxury cars like Mercedes-Benz and Lexus are using them as delivery vehicles. I hate it when Jimmy John's driver has a better car than I do. A British couple bought an 18th century fixer-upper. When they got around to fixing it up, they found under the kitchen floor a cup full of 400-year-old gold coins, and they're valued at $820,000. Apparently, in this crazy real estate market, houses are still a good investment, especially if you find $800,000 under the kitchen floor. A Florida man crashed his Walmart mobility scooter into the store shelves and was arrested for drunk driving in the store. And they found an open bottle of vodka in his basket. He was charged with SWI, that's shopping while intoxicated. That's usually when I get my best bargains. And finally, our headline of the week is, Canadian woman's upset stomach turns out to be a baby. I'm no expert in biology, but I'm asking, how does this happen? Yes, I know how she got pregnant, but I don't understand is, how do you go to Walgreens for Tums and come home with a baby? On the podcast today, we have ROTHSCHILD, Kendall Bauer, Joel Dresang, and wrapping up the week, here's Kyle TETTING.
Well, thank you, Max. Some words from the Packers quarterback this week suggesting perhaps that you don't want to speak a loss into existence by talking about the potential of losing to the Jets. If only it worked that well for the markets as well. The S&P down 1.5% this week. The NASDAQ down 3.1%. The Dow Jones Industrial Average, in a bit of a twist, finished the week positive, although largely because of some specific earnings news in the very focused 30-stock Dow. For the year, the NASDAQ down 33.6%, entering a second bear market in the midst of a first bear market. The S&P down 23.8%, and the Dow Jones Industrial Average down 17.1% for the year. For the first time since 2008, the yield on the 10-year benchmark U.S. Treasury closing north of 4%, a fairly significant milestone given how low interest rates have been and for how long they've stayed that low. Maybe not the be-all, end-all as far as what we're seeing from rates, but I think an important indicator to suggest that what the Fed is doing is having an impact on broader rates, certainly having an impact on the opportunity set out there for everything from mortgages to what you can get on your bank accounts. So plenty this week to discuss. Art, we had an inflation report on Wednesday that, kind of whipsawed the market. We opened quite poorly on the news that inflation's still running a little bit hot, at least the core personal consumption core CPI number running a little bit hotter than what I think many people would have been comfortable with. The market opened down significantly, and somehow we closed positive on Wednesday.
Yeah, the biggest whipsaw for the Dow in history. And unfortunately, I think it might have lulled some people into thinking that, oh boy, it's safe to get in now, it's rally time. And your comment about the NASDAQ is another indication of why you shouldn't be lulled into some false sense of security when something goes up. July was a good month for the NASDAQ. We supposedly, and we questioned it at the time, we considered it to be kind of a head fake then, because we had a rally, and now we're significantly below where we were. So my suggestion for investors is just don't look at it. Understand what's going on and why. Realize that we're in a bear market, meaning stocks are down more than 20% across the board. This 4% news, to a certain extent, I think it's good news. Even though it's a higher level than we've been at for a long time, versus earlier in the year when the bond investors were expecting the Fed to have to change course and start to moderate their increases or actually reduce interest rates because they expected there to be a recession coming. And I think what the markets are now accepting is the fact that we're going to need higher rates for an extended period of time in order to bring inflation to its knees. And that's what the Fed's going to do. And so the reality, the acceptance by the markets that the Fed is going to do its job. We are going to have a slowing economy. This could last for quite a while. And we should get used to this.
And on that 4% number, I think important to point out that the more pain we feel in the bond side of our portfolios as interest rates rise, and to be quite clear, as interest rates rise, the value of your existing bonds tends to go down temporarily. I use that word temporarily. I'll come back to it in a second, but it goes down because new bonds issued at these higher rates look more attractive. The thing you have to remember is that when you buy a bond, you're buying it knowing that at some point in time it matures. There's very few examples of bonds that don't ever mature, none that I can think of here in the U.S. And so at some point in time, that bond matures, and most importantly, as a bond investor, you know what it's going to mature at. You know that you're going to get par back as long as the company, as long as the country, as long as the municipality that issues it is still around and still able to pay their bills. And that's why quality is so critically important. You know you're going to get your money back. And so what's left is, how long will it be until that bond matures at par? The further out you look, the more sensitive your bonds are going to be to rising rates. It's why we've tried to stay in that short to intermediate space for the better part of really the last decade. You weren't getting paid much more to look further out, to take more volatility. But of course, now all of a sudden, you get paid a little more to hold those bonds. And so there's two things that I think are incredibly encouraging for bond investors. One is the losses they've seen. Well, they're going to capture some of that back as bonds finally mature at par. The second is that as they reinvest that principal, as they reinvest that money that's coming back to them, they can do it at 4 or 4.5 with the same risk that they were taking 10 years ago to get 1.5 or 2. And that's the key is, just because the return is higher, just because we've been hurt recently in our bond portfolios, it doesn't all of a sudden make bonds more risky. We understand how we got here. And if anything, higher rates actually lower the volatility as we look ahead. So I think very encouraged about kind of what that path looks like.
Kyle, do you think this is something that investors are a little bit scared about because they haven't seen this in a while, and so they don't understand here's the safe part of their portfolio and it's jumping around?
Yeah, and rightfully so, Joel. I think it's understandable to be concerned when we keep saying, well, this is the safe piece of your portfolio. Safe is a relative term, not an absolute term. And so relative to stocks, bonds bounce around less. Even in the worst year we've seen for bonds in a very, very long time, and we need to be clear that that's what we're in, bonds have bounced around less than stocks. That's not comforting when your intermediate term bond is still down 8, 10, 12, even more, because, again, you were thinking that that was going to be the piece that was more or less what it was supposed to be worth. Of course, remember that all of this is setting it up for what the next 5 to 10 years look like. It's a pretty attractive opportunity to buy into bond markets right now. If you aren't already holding those bonds, if you're sitting on the sidelines, or if you're going, well, I'd really like to take less risk in stock, I think bonds provide more opportunity. And of course, we're getting those phone calls right now. The call volume has escalated. And I think rightfully so. When you have those kinds of concerns, Kendall, I think not just on the stock side, but the bond side as well, how do you talk to investors about what's going on and most importantly, what they do about it?
Yeah, I think the first thing you got to do, and everyone at this table does a good job, is acknowledging that it's been an extremely difficult year for stocks and bonds. And we're not used to seeing those two fall together. But we have seen it in the past, and it doesn't mean that that's going to continue on forever, and it's certainly not a reason to, throw in the towel or to give up on your investment plan. Now's the time, if you're feeling uneasy, if you're struggling to understand what's going on, to call your advisor. We will be there to pick up the phone, and it's our job to walk you through what's going on, to help you understand what's going on, and to remind you, hey, look, every bear market ends just like every bull market ends, and that eventually things will get better. But having a plan in place, and again, this is why we have built portfolios the way we have for going on 30 plus years, is because we know it works over the long haul. We're never going to escape corrections. We're never going to escape bear markets because they're a normal part of market cycles and what happens. But if you put yourself in a position to weather the storm, you can avoid that natural fight or flight response of trying to tap in or tap out, or try to go to cash and play that game, because we all know that doesn't work out well, for most people.
And I think you hit the nail on the head. It's perfectly natural to want to respond to these types of situations. I think the choice that kind of, the gut tells you is, well, let's run from this, or let's fight it, or let's, forgetting, of course, that, yeah, okay, we're in the middle of a lot of uncertainty. Any choice we make now, we're making in the absence of good information. And so sometimes it's better to trust the plan and wait to see how things shake out than it is to simply respond even when it feels like response is the right answer. Doesn't mean we're not doing anything. It doesn't mean that within your individual investments nothing is happening. The portfolio managers that run the stock funds you own are buying and selling every day. The same for your bond funds. They're looking for opportunities. And so, yeah, that's all on the margin, but sometimes you just got to trust the plan. And, I feel, at least for now, like that's where we are. We're at a period of time in which it hasn't worked. It doesn't mean that it doesn't work. It just means that, some of the uncertainty that's out there right now has been more challenging than most other periods.
It is a time, though, as you indicated, to perhaps take some action so you don't feel as helpless as things have been going down. And even though what we do works over long periods of time, even though, as you suggest, we will make money over long periods of time, always have, this time period, and you made a comment on this in our meeting on Monday, I think is the worst ever for balanced portfolios, because you have bonds not going up, and even worse, doing almost as badly as stocks over the past 12 months, and not quite so much, but very poorly over the past year to date. So to turn a negative into a positive before the year ends, investors should look to more tax loss selling in your taxable accounts. If you have a loss, take it. And if you're uncomfortable with anything, perhaps you might want to shorten durations if you haven't already, despite the fact that you'll gain if you hold for the long haul. Perhaps you'll be more comfortable with something different, and your advisor will talk to you about that. The other thing is the stylistic difference we're always talking about, growth versus value. For 10 years, if you didn't have growth stocks, you didn't make any money. During the pandemic year, if you didn't have growth stocks, you didn't make as much money. But then all of a sudden, something started to change. This year, the Biden administration announced plans to make it tougher on exporters of semiconductors and semiconductor making equipment to do business with China. That's going to dampen, I think, global demand, definitely Chinese demand, for things that American manufacturers are selling. So that could have a negative impact. It already has on the stocks of those companies. So it is possible that growth stocks won't perform as well, at least in the near term, and good old dividend-paying value stocks might be a better place to put some money and the spread between the loss on the NASDAQ stocks and the S&P isn't all that great. Might be time to modify your portfolio to give you something that will give you a little smoother ride.
Yeah, I think all of those are reasonable opportunities to feel proactive without completely abandoning the long-term plan, right? To take some action that can help, without giving up entirely, which is kind of the risk we face when we're unsure about what the future looks like. There's this tendency to want to give up, and that's usually the wrong direction to head, save for, those small number of outcomes where, that would have been the right way to go. Joel, quite a bit of economic data that we touched on, but maybe you can shed a little light on the specifics of this week's inflation report.
I had an uncle who was a long-haul truck driver. Was he a semiconductor? Sorry, I had to get that in there. We didn't have a lot of reports, but they were big reports. We already talked about the consumer price index and what that did to the markets, and it was interesting because it showed the year-over-year increase of 8.2%, which was down for the third month in a row, and down from 8.3%. So marginal difference from August, but. The analysts, quote unquote, were saying that it was going to be 8.1%. So a lot of the hullabaloo was all about that it wasn't as low as analysts thought. But the point we made before about the core consumer price index, which strips out the more volatile aspects of food and energy, that went up to its highest mark since 1981, and what that's suggesting is that when you strip out food and energy, that the core, as it's called, that inflation is broader than maybe we expected before. So that makes, it's been stubborn to get this inflation down, and that suggests that we have to do more than just work on the food and energy aspects of it.
And I think important to point out that the core number lagged headline CPI on the way up. So it makes some sense that as headline CPI has at least peaked out for now and is on its way back down, that core might take a little while to get there as well. Remember that energy costs and used car prices, two of the things that spiked very early on that caused some of the early days of inflation last year. This time, those energy prices in particular making the year-over-year comparison more difficult for the headline number. No impact whatsoever on core because it strips out that energy number. And, of course, it takes some time also for those energy costs to be felt in other areas of prices, right? If energy is one of your input costs, as it is for so many manufactured goods, well, it makes sense that maybe you won't pass those costs on immediately, but they'll build up over time and eventually make their way then into the core number. So I'm not surprised that there's been a little bit of a lag in the core increase. I'm not surprised that the headline number has been the first one to come down. It follows very much the way that things began. And I think in turn, we'll see soon enough that the Fed's stance and the Fed's ability to combat inflation has an impact not just on the headline, but the core as well.
Right. Also, out of the CPI, the sunny side is that the raise for Social Security benefits went up, and it's going to be 8.7% in 2023. That's the biggest raise that beneficiaries have had since 1981, when it was 11.2%. So that's a big jump, and that's going to help a lot of people.
Well, and I think that's critical to making sure that in particular seniors are not overwhelmed by the impact of the inflation we're feeling. Yeah, we assume that eventually it comes back down, but it doesn't mean that those prices that have already increased suddenly go back down. It's just that the rate of inflation will slow, and so you need things like an increase in Social Security to help offset what will be higher prices for a very long time.
And it helps point out how helpful that benefit is. There aren't a lot of things you're going to be getting as a regular source of income that adjust with inflation like that. So that's a pretty good deal.
And some employment information this week as well?
Yeah, we had initial claims for unemployment insurance. That's gone up the second week in a row, and that's looking at the 4-week moving average, so that's a less volatile number. 2 weeks isn't a whole lot. It was 2 weeks out of the last 9 that it went up. But the fact that it's going up a little might be a sign that the Fed is having an effect with raising interest rates, and businesses are maybe letting more people go. We had numbers earlier this month about job openings, and there were 1 million fewer in August than there were in July. But at the same time, we have other numbers, like the unemployment rate, that are at 50-year lows. So, again, it's sort of a mixed bag. We've got numbers showing that the economy is relatively strong, but there are signs out there that it might be weakening a little, and that's what the Fed wants.
Yeah, and I think we've had this kind of debate of, are we in a recession? Are we not in a recession? We come back to quite frequently, what's the technical definition versus what's that rule of thumb? And I think, for so many, the broad economic strength has been the one thing that we've been able to point to say, okay, maybe the recession isn't quite here yet. And if we do see some slowing, maybe it's just a little more confirmation of what most of us already knew, which is things aren't as great as we thought, but also they weren't as bad as a lot of people thought too. And that's okay, right? That's what the Fed is trying to do, is I think get people to realize that things can be a little slower and we can still be okay. And that allows us to come out on the other side of this. It allows us to see what that looks like, and most importantly, to start to put some thoughts behind the when. And I think that's the critical piece that so many people want to know is, when's the Fed going to stop? When can the markets finally rally from that? When can we finally get into the recession that we all think is coming? And not putting words in people's mouths around the table, but I think there's a general sense that the likelihood of a recession is fairly high given what the Fed is doing. And so what you're left with is kind of this element of time. You're left with this idea that, okay, we've got to get past all of the current uncertainty, or at least enough of it, to a point in time, maybe late winter, spring, where there's some additional clarity from the Fed on, okay, here's what comes next.
And we can look at these numbers and say, the economy's slowing or it's not, but the Fed's looking at it with their own expertise, and they're going to be deciding when it's time to stop, raising rates.
And to be clear, they've been very, very willing to tell us what they see, which is atypical from history. You go back to prior rate tightening cycles, and we didn't get the kind of advance notice that we've been getting. Yeah, some of it was maybe a little wrong, especially early on in this rate cycle. This idea that inflation was completely transitory. Well, we've seen in some areas it was. Unfortunately, in a lot of other areas it wasn't, or at least not transitory enough, if that's a clear enough statement. And so, yeah, I think this is one of those cases where the Fed wins this war. It's just unfortunately taken a little while longer, and probably will have a little more collateral damage than what so many people were hoping early on. Well, thanks for listening to us. We enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.